The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
Good morning on this cool, crisp, clear day on Long Island. You're listening to Money in the Morning with Mitch Goldberg, and this is 103.9 103.9 FM, LI News Radio. And we are so glad that you are joining us. We have a lot to go over today. Markets, money, personal finance, hopefully more money in your pocket. And that is always a good thing, because this show is about helping you to become the best possible version of your financial self. Doesn't that sound nice? That's what we want. So let's get into a couple of things. Lots of news to digest. The big things that we will do is, first we're going to break it down just for you and make this into a relatable thing that helps you move forward in your life financially. The two big things right now are the Powell speech at the Economics Club of Washington yesterday, and Powell knows that that was a very widely listened to speech. And the other thing is last night's State of the Union. And believe me when I tell you, folks, the Powell speech is going to be a much bigger deal for your investments, for your personal finances, than a State of the Union address. We know that a State of the Union address, regardless of which president does it, and I've been following these my entire adult life, I'm 55, so they are about throwing red meat to the base. They are about chiding the other side. They're about touting their accomplishments and talking about all the great things that they're going to do for us going forward. That's what State of the Union speeches are. They're more like rah-rah speeches that we are, that they're obligated to do. They don't really tell a whole hell of a lot. We have lots of things that need to be fixed. The infrastructure bill is helping. The CHIPS and Science Act is helping. The infrastructure is the biggest investment in infrastructure in decades. That's happening everywhere. Every state is getting money. The Inflation Reduction Act, big jobs creator. There's a lot in that, and the other stuff that he's got going on. So, and the Inflation Reduction Act. Lots going on, and there's good and bad and everything, but that was what he was touting, and that is one of the reasons why jobs continue to be strong, and the labor market, the labor figures came out last Friday, 517,000 new jobs, lowest unemployment rate since 1969. That is striking, and I think that is just beyond anybody's expectations, because you'd think with the Fed raising rates, trying to slow the economy down, bring down inflation, that we would see a negative impact on the labor market, but it just hasn't happened. Interest rate hikes operate with a pretty big lag, so we could still see a weakening or moderating in the strength of the labor market, and that would go a long way in helping to bring down inflation. It would also go a long way in getting the Federal Reserve to a point where not only do they stop raising rates, not only do they hold rates steady, but even get to a point where they start to cut rates. Okay, so that's the big thing. The big things. The Fed speech, the Federal Reserve Chairman's speech, though, was by far the bigger thing. And he introduced a new word to the economic lexicon: disinflation. He used that word a bunch of times. It's the new word. It replaces the word transitory. If you remember, a year ago, the Fed was using the word transitory to describe inflation. If you think about it, everything is transitory. Life is transitory, but in the terms of economics, things that last a year or more are not really transitory. But inflation figures are coming down, still much, much higher than they were pre-pandemic, and there's lots of reasons for that. Just the disruptions and the change to the global economy was nothing we've ever seen in modern times. But things are starting to moderate. Supply chains are catching up. Inventories are going up for everything, including cars, semiconductors. Even the price on the wholesale level, the price of eggs is actually plunging right now. And you'll start to see that in the supermarket for the retail price of eggs should start coming down if you haven't seen it already. I've seen it already in my supermarket. So we keep getting these spots of inflation. We had lumber. Then we had eggs, and we'll have something else. It's rolling inflation. We did have tens of millions of chickens that had to be culled because of a horrendous avian flu, and that's basically what caused the price hike with chicken or with eggs. So that is starting to moderate, but it does take time to produce new little chicks and get them into egg laying mode. Okay, so that's what's going on there. We've got a couple of things to take a look at. So let's get to all of the good things that we're going to start with. First, we've got Dow futures off 124 points. Not much, 0.36 after the Dow was up yesterday. S&P futures off 0.5%, down 21 points. Nasdaq futures off about 0.5% as well, off about 60 points. Oil, which was up over $3 per barrel yesterday, is up another $1 per barrel today at $78. And the 10-year yield, which has been moving up a lot actually since last week, we've been talking about that. The yield is off just ever so slightly today. All right. Couple of things to keep an eye out for are earnings coming out. Earnings out this morning, big stock movers. Uber had its best year ever, best quarter ever. Best year was 2022. Obviously, we're talking about that year. The stock is up 7%, blows out earnings, revenues, good things for the future. Chipotle fell a little bit more than 5%. Disappointing quarterly results. So that stock is letting out a little gas. Here we go. Okay. Microsoft is up a little bit. Yesterday we spoke almost the entire show about AI-powered GPT, their new chatbot, GPT. I can't even pronounce it because they made a huge investment into a company called OpenAI. We're going to talk a little bit more about that as time goes on. Under Armour is up 8%. Finally, nice beats on earnings and revenue. That stock has been in the doghouse for such a long time. And what else have we got? Yesterday, energy was the winning sector of the day. But what I do is to follow the sectors as I look at the 11 Spiders exchange-traded funds, S&P depository receipts from State Street. If you want the list of what I'm looking at, email me, mgoldberg@clientfirststrategy. And if you want to learn more about what I do here, you can check out clientfirststrategy.com. No obligation on your part, guys. But there's 11 sectors of the economy. One is energy, there's technology, communications, materials, financial, healthcare, industrial, consumer discretionary, utilities, real estate, consumer staples. By the way, the difference between consumer staples and consumer discretionary, consumer staples, those are things you need. We call that food, toilet paper, and toothpaste. That's the stuff that you have to spend money on no matter what the economy does. Consumer discretionary is luxury goods, like Tiffany jewelry is considered a luxury good, for example. Okay, stuff that you don't need. So we have to discern between the two when we talk about consumer stocks. But if you want to know which sector, percentage-wise, is the closest to its 52-week high, it's industrials. And if you look at stocks like Textron and Boeing and Caterpillar, you see that industrials, which are economically sensitive, are on a tear. They've been on a tear for a while. We've been talking about this. And if you take your message from the market, it's basically telling you that investors expect the economy to accelerate. not go into a recession. And with the economic statistics as of late have been so much higher than expected, we've gone from talking about recession to talking about we have a soft landing or no landing at all. So a lot going on, and I'm just trying to help you piece it together. And why? Because every now and then someone is bound to completely get out of the market or make one overall giant move, an all or nothing move, which will blow a hole in their retirement. And if you're educated and filled in on all this stuff, you're more likely to stick with your investment plan. Because what good is an investment plan if you can't stick with it? You are listening to Money in the Morning with Mitch Goldberg on 103.9 FM, LI News Radio. We'll be right back after these brief messages. All right, we're back. Let's hit that music and wake up. All right, everybody, wake. We are awake now. We were talking about Roth IRAs because it's nice to talk about the market and individual stocks, Fed policy, and you have to include politics in this stuff because politics influences decision making and it affects us. We don't have control over that, but we have to talk about this stuff. And ultimately, if all of you just went with the thought that I'm going to invest in a portfolio of investments, of securities, that's based on my time horizon, my goals, my risk tolerance. You wouldn't even have to know all this stuff. But I think if you and I are aware of this and educated about it, plus I do find this fascinating, we are less likely to make knee-jerk reactions, knee-jerk moves. So if you're just properly invested, diversified, you get through this, and you could just focus on the things you can control. Now, what I have to say, you can't invest directly into an index, but you could invest in a security that tracks or mimics an index. There is a difference. So you could invest in an index fund, but you can't invest in the actual index itself, regardless of how low the expenses are for the index fund. And the other thing is that diversification is a strategy that we use to mitigate risk, but it doesn't protect your portfolio from going down in a generally down market, like the one we had last year and this year. The tough thing last year was that when stocks went down, bonds went down too. Usually you have at least bonds holding up or going up a little when stocks go down and vice versa. So bonds act as a risk diversifier and a ballast to your portfolio, but we didn't have that last year. On the converse, the bad thing for this year is that everything is up this year. I prefer things to be up and down at different times. Over the long term, I expect all my investments to work out. I expect them to, no guarantee. But if my investments work out at different times, it smooths out the volatility. And instead of seeing giant drops in my portfolio or giant ups in my portfolio, I'll see a more moderate performance, a smoother ride. And that, in turn, will keep me invested for the long term. So darting in and out of the market and timing the market, I want to focus on time in the market. But if stocks are acting outside of my portfolio, if my portfolio is being knocked around outside of the bounds of my emotional capability to stick with my investment plan, then I'm not going to stick with the investment plan. And therefore, I've lost the ability of time in the market, and now I have to rely on timing the market. And if you get out, when do you get back in? You wait for better days to get back in, but then the market goes up, then you'll be like, oh, I could have bought when it was lower. And you wait for the market to go lower, then it goes lower, and you say, now I'm waiting for the market to go even lower. And when the market goes up, you wait to get back involved in the market, back invest. You wait to get back invested. But then the market goes up. You say, darn it, I don't want to buy now because I missed the upside. I'm going to wait for the next downside. And you just hesitate forever. And then 5, 10 years later, 20 years later, you look back and you say, what was I doing sitting in cash this whole time? That's why I want to keep you invested. And I think if you have the knowledge, and if I could share this knowledge with you, you are more likely to stick to your plan. Now, if you don't have the plan that's right for you, that's a different story. And a lot of people don't. A lot of people just buying the hot stuff. They bought the crypto because it was hot. They bought pot stocks because they were hot. They went all in on cloud stocks because that sector was hot. I actually see it starting to form now with artificial intelligence stocks because, they're getting hot because Microsoft is investing billions all of a sudden into a company called OpenAI and to better compete with Google. But Google is not sitting there doing nothing. They're investing billions into Bard, their new or updated OpenAI version of artificial intelligence. Anyway. Some of the things you can control is Roth IRAs. You could control moving some of your IRA money into a Roth. You see, when you have a 401k or 403b or other plan-sponsored retirement plan, it's not all yours. You think it's yours, and you look at it and say, look at all the money I've accumulated. I have a lot of money. But, roughly a quarter to a third of that for many of you, if not most of you, is not yours. That's going to taxes. So the thing is, if you convert if you move that money into a self-directed IRA, and does it make sense to convert all of it or some of that money into a Roth IRA? When you convert money from an IRA to a Roth, all of that money counts as income for the year that you move the money over. So let's say you have $1 million in an IRA. Maybe you want to move $100,000 a year or $50,000, and vice versa. If you have $100,000 in an IRA, maybe you just move $10,000 over per year into a Roth. It creates a tax event, though, for you that year, the year you do that. So you're going to have to pay the taxes, which means you're going to have to come up with more money. So, you know what they say, it takes money to make money. So what do you do? Well, here's the thing. If you expect your tax bracket to be lower in retirement, and I think not just one or two brackets, if you expect it to be a lot lower, which for most of you, many of you, it doesn't turn out to be the case. It pays to pay the taxes now, insulate yourself from higher taxes down the road. When taxes go up, I call it tax inflation. Plus, presumably, your retirement account will be bigger in the future because of the growth potential, which means you're paying taxes on more money. So you pay taxes on less money now, or pay more taxes on more money down the road. Those are the things to consider when making a Roth converting your IRA money to a Roth. And I'm bringing this up. It's like a focus for me this week with you because it's so important that you have your taxes under control when you retire. Your income affects your IRMA, which is the money. Okay, it's the income-related monthly adjustment amount, how much money you have to contribute to your Medicare. Already, if you live on Long Island, you are paying money on 50 to 85% of your Social Security benefit. Because if a couple makes $44,000 or more a year, then your Social Security is taxed at 85% of it is taxed. I'm not saying 85% of it goes to taxes. 85% of your Social Security benefit is taxable income. So it behooves you, though, to lower your taxes if you can for retirement. And there are some rules to know. If you convert your IRA to a Roth IRA before the age of 59 and a half, and you use some of that money to pay the taxes, that money will also have a 10% penalty, because any money that doesn't go into the Roth is a taxable distribution. That is it's all a taxable distribution, but it's subject to the 10% penalty if you're under 59 and a half. So this is why us financial advisors generally want you to have the money set aside in cash on the sideline to pay the tax of moving all or a portion of your IRA into a Roth IRA. And if you can't do that, then it may negate the need and desire to do it. All right. If you can do it, there's a 5-year rule for each conversion. Even if you're over 59 and a half, that when you convert money from an IRA to a Roth IRA, you have to leave that money there. You can't take it out for 5 years, because if you do, your contribution is tax-free, but any earnings are subject to income taxes as opposed to getting the tax-free status, which is what Roth IRAs are all about. So we need to talk more about this. And this is the personal finance part. This is the part where I really like to say I excel and I enjoy the stuff. I enjoy making people's lives better in retirement. You're listening to 103.9 FM LI News Radio, Money in the Morning with Mitch Goldberg. I so appreciate you joining us, and we'll be back tomorrow morning. Thank you.
Securities and investment advisory services are offered through Next Financial Group Incorporated, member of FINRA SIPC. Client First Strategy is not an affiliate of Next Financial Group Incorporated. All the views expressed are those of Mitchell Goldberg and Client First Strategy and not those of Next Financial Group Incorporated. Views are general in nature and not intended to be investment advice. Any discussion of individual securities should not be construed as a recommendation or solicitation by our presenters. Next Financial Group Incorporated does not provide tax advice.
The views and opinions